Hello everyone, welcome to Betty Academy. Our job is to make school easier. Kindly subscribe, watch our videos, like, share, comment down below, and don't forget to hit the notification bell. So in this lesson, we are going to learn about the capital structure theories. Under these capital structure theories, uh, to we are going to learn about the traditional approach. So the traditional approach to capital structure suggests that there exists an optimal debt to equity ratio where the overall cost of capital is the minimum and the market value of the firm is the maximum. Yeah, so that's what it holds, that there is that optimal debt to equity ratio where the overall cost of capital is the minimum and the market value of the firm is the maximum. On either side of the point, changes in the financing mix can bring positive change to the value of the firm. Before this point, the marginal cost of debt is less than the cost of equity. And after this point, vice versa. So we have the capital structure theories and their different approaches put forth the relationship between the proportion of debt in the financing of a company's assets, the weighted average cost of capital, otherwise referred to as WACC, and the market value of the company. While the net income approach and the net operating income approach are the two extremes, the traditional approach advocated by Esther Solomon and Fred Weston is a midway approach, also known as the intermediate approach. Yeah. So we go to the traditional approach. So it further says that the traditional approach to capital structure. So the traditional approach to capital structure advocates that there is a right combination of equity and debt in the capital structure. So there is that right combination at which the market value of a firm is maximum. As per this approach, debt should exist in the capital structure only up to a specific point, beyond which any increase in leverage would result in the reduction in value of the firm. It means that there exists an optimum value of debt to equity ratio at which the WACC is the lowest and the market value of the firm is the highest. Once the firm crosses that optimum value of debt to equity ratio, the cost of equity rises to give a detrimental effect to the WACC. Above the threshold, the WACC increases and the market value of the firm starts a downward movement, right? So we have those assumptions under which the traditional approach, these ones are the assumptions. Yeah, so I will just go through these assumptions. Yeah, I will expound on them. So one, the rate of interest on debt remains constant constant for a certain period, and thereafter with an increase in leverage it increases. Yeah, so the rate of interest on debt, it remains constant for a certain period, and thereafter with an increase in leverage it increases. So there's that particular period that it remains constant, but after that it starts to increase. Number two, the expected rate by equity shareholders remains constant or increase gradually. After that, the equity shareholders starts perceiving a financial risk, and then from the optimal point and the expected rate increases speedily. So that is the other assumption. Yes. Then three, as a result of the activity of rate of interest and expected rate of return, the WACC first decreases and then increases. The lowest point on the curve is optimal capital structure. So those are the assumptions under which the traditional approach holds. Yeah, those are the assumptions. So I hope you've learned something. Yeah, under the traditional approach. That one falls under the capital structure theories, yeah, whereby it advocates that there is the right combination of equity and debt in the capital structure, at which the market value of a firm is maximum. And again, also the cost of capital also is it at its lowest, and that's where the market value of the firm is maximum, and it can only hold under when these assumptions are there. Yeah, so I hope you've learned something. Kindly watch out for our next video, and don't forget to subscribe and hit on the notification bell. Until next time, bye.